program is the active center.
All right, welcome. Today, we're going to pull back the curtain on stocks, bonds, and mutual funds. Seriously, by the time we're done here, you'll get the big ideas behind how money can grow in the market. So let's just jump right in.
So let me ask you something. Have you ever used a product or a service and just thought, wow, this company is incredible. I wish I could get in on that success? Well, guess what? You actually can. And that's pretty much the core idea we're going to unpack today.
Okay, here's the game plan for our little journey. First, we'll talk about what the market even is. Then we'll dive into the two heavy hitters, stocks and bonds. After that, we're going to talk about the so-called free lunch of investing, see how mutual funds make it easy, and wrap up with a really big question you'll have to ask yourself.
All right, first up, welcome to the market. Let's get right down to it. Why does the stock market even exist? You can really think of it as a story about two sides of the same coin, both needing each other.
See, on one hand, you've got companies. They've got big ideas, they want to grow, innovate, build the next big thing, but they need cash, capital to do it. And on the other hand, you have regular people like us, right? We have some savings and we'd love a chance to share in the success of those awesome companies. The stock market? It's simply the bridge that brings those two groups together.
Okay, so let's get into our first main topic, stocks. This is all about being an owner. If you've ever wanted to get your own piece of the pie from a company you love, well, this is how it's done.
So what is a stock really? It's so much more than just a ticker symbol and a price on a screen. Think of it as a tiny slice of ownership. When you buy a share of a stock, you literally become a part owner of that business. And what that means is, if the company does well, you do well. The value of your slice can grow as the whole company grows.
And you know, getting your hands on a stock is probably simpler than you imagine. It really just comes down to three basic steps. First, you open what's called a brokerage account. That's basically your ticket into the market. Second, you put some money in it. And third, you place an order to buy shares. That's it. Now, when you buy a stock, there are fundamentally two ways to think about it. The most common way is taking a long position. This is super simple. You buy shares because you believe the company will do well and its value will go up. But there's a flip side, a more advanced strategy called a short position. That's where you're actually betting that the stock's value will go down. It's a bit more complicated, but it's the other major force at play in the market. Okay, so we've talked about stocks, which is all about owning a piece of a company. But what's the alternative? Well, that brings us to the other side of the investing coin, bonds. With a bond, you're not an owner. You're the lender. You're the bank.
So what's a bond? Just think of it as a formal IOU. It's that simple. You're lending your money to an organization, maybe a government or a big corporation. And in exchange for your loan, they make you a promise. Two promises, actually. First, they'll pay you regular interest payments, kind of like a thank you. And second, at a set date in the future, the maturity date, they promise to give you your original investment back in full. It's a very straightforward deal.
And of course, not all IOUs are the same. You've got options. You can lend your money to the national government. These are considered super safe. Or you could lend to a state or city to help build schools or roads, and you often get a nice tax break for doing that. Then there are corporate bonds, where you're lending to a business. The risk can be higher there for sure, but so can the potential payout.
Okay, so we've got stocks for ownership and bonds for lending. Great. But let's be real, both have risks, right? What happens if the company you invested in goes bankrupt? Or what if the government or corporation you lent money to can't pay you back? This gets us to the single biggest problem in investing, and luckily, its most famous solution. And that solution is a word you've probably heard before, diversification. It really just boils down to that classic advice, don't put all your eggs in one basket. The whole idea is to spread your money out across a bunch of different investments. Why? So that if one of them takes a nosedive, it doesn't drag your entire portfolio down with it. You're insulating yourself from the failure of any one single thing.
And hey, don't just take it from me. The legendary founder of Vanguard, John Bogle, he said it best. He called diversification about as close as you can get to a free lunch in investing. I mean, think about that, a free lunch. And why did he say that? Because it's one of the only strategies out there that has the power to lower your risk without automatically forcing you to give up on your potential returns. It's a pretty amazing concept. So what's the magic behind this free lunch?
It's a concept called imperfect correlation. Now, that sounds super technical, but the idea is actually really simple. It just means that different types of investments don't all move in the same direction at the same time. The big aha moment from economist Harry Markowitz was this. When your stocks are having a terrible day, your bonds might be doing just fine, or even going up. They act like a seesaw, balancing each other out and giving you a much smoother ride overall.
Okay, that all sounds fantastic in theory, right? But how on earth does a regular person go out and buy hundreds of different stocks and bonds to get diversified? It sounds like a ton of work. Well, that's where the most practical solution of all comes in, the mutual fund.
A mutual fund is an incredibly powerful idea. Just imagine this, thousands of investors all pooling their money together into one giant pot. Then a professional manager takes that huge pool of cash and does all the work for you. They go out and buy a fully diversified portfolio of stocks, bonds, or whatever on behalf of everyone who chipped in.
So why are these things so incredibly popular? Well, the advantages are pretty obvious. First, you get instant diversification. With just one click, one purchase, you're spread out across tons of investments. Second, you get a pro managing your money day in and day out. And third, it's just so much easier and cheaper than trying to build that same portfolio all by yourself. It's a game changer for most people.
And a perfect example of this is the classic 60-40 fund. It's a super common strategy. The fund puts 60% of its money into stocks, aiming for that long-term growth, and the other 40% into bonds to provide some stability and income. For anyone who wants that balance between growing their money and playing it safe, it's a go-to all-in-one solution.
And of course, mutual funds come in all shapes and sizes, built for pretty much any goal you can think of. If you're all about growth, you've got equity funds that are packed with stocks. If you need steady income, bond funds are your friend. If you want a little of both, hybrid funds have you covered. And if your number one priority is just keeping your money safe, there are money market funds. Seriously, there's a flavor for everyone.
Okay, so we've laid out all the building blocks, stocks, bonds, mutual funds, but the big question is, how do you put them all together? And when it comes to diversification, it's fascinating because two of the greatest investors of all time, well, they don't exactly see eye to eye.
So in one corner, you've got the legendary investor Peter Lynch. And his take is that the number one benefit of diversification isn't even about the money. It's psychological. It's what gives you the mental toughness, the stomach, to not panic and sell when the market gets really rocky, which, by the way, is exactly when staying put is most important.
But then in the other corner, you have Warren Buffett, and he comes in with this really provocative counter-argument. He famously said that diversification is a protection against ignorance. Basically, he thinks it's for people who don't know what they're doing. His argument is that if you've really done your homework and you know your stuff, it makes way more sense to put a lot of money behind your absolute best ideas.
And that really leaves us with the big question for you to think about. Is diversification that amazing free lunch we talked about, a powerful tool that every single investor should use, or is Warren Buffett right? Is it more of a crutch, a safety net for people who aren't experts? Your answer to that question will probably say a lot about the kind of investor you're going to be.